Bollinger Bands are a popular tool for traders. Many people use them to analyze financial markets. They are especially useful in Forex trading. These bands help traders understand price movements. They show how volatile a market is at any given time. This information is very valuable. Bollinger Bands provide a visual framework. This framework helps to make better trading decisions. They are a key indicator for many technical analysts around the world. Forex markets are known for their fast pace. Prices can change very quickly. Bollinger Bands help traders navigate this active environment. They give a clear picture of market conditions. By looking at the bands, traders can see if prices are high or low on a relative basis. This helps them decide when to buy or sell. The bands adapt to price changes automatically. This makes them very practical for the dynamic Forex market. Many successful traders incorporate them into their strategies. I developed Bollinger Bands some years ago. My goal was to create a tool that could adapt. I wanted something that would adjust to changing market volatility. Most indicators at the time were static. They did not change with the market's mood. Bollinger Bands are different because they are dynamic. The bands widen when the market is choppy. They narrow when the market is calm. This adaptive nature is what makes them so powerful for traders. In this essay, we will explore Bollinger Bands in detail. We will learn how they are constructed. We will look at each part of the bands. This includes the middle line and the outer bands. We will also discuss common trading strategies. These strategies use Bollinger Bands to find opportunities. The main aim is to help you understand these bands. Then you can use them more effectively in your own Forex trading. We will keep the explanations simple and clear. The moving average is the central component of Bollinger Bands. It forms the middle band of the indicator. A moving average helps to smooth out price data. It shows the average price over a specific period. For Bollinger Bands, we typically use a 20-period simple moving average, or SMA. This means it calculates the average price of the last 20 candles. This middle band acts as a base for the upper and lower bands. It gives us a reference point. The moving average in Bollinger Bands provides a baseline. It helps traders understand where the current price is. Is the price trading above its recent average, or is it trading below its recent average? This is a fundamental question in technical analysis. The middle band offers a quick answer. It acts as a center of gravity for price action. Traders pay close attention to how the price interacts with this middle line. This interaction can give clues about the market's strength. Often, the middle moving average can act as support or resistance. When prices are falling, they might find support at the middle band. This means the price could stop falling and bounce upwards. If prices are rising, the middle band might act as resistance. This means the price could stop rising and turn lower. This does not happen every time, of course, but it is a common behavior that traders observe. Watching for these reactions can be very helpful. The standard period for the moving average is 20. However, traders can adjust this setting. Some traders prefer shorter periods, like a 10-period moving average. Shorter periods make the middle band react more quickly to price changes. Other traders might use longer periods, like a 50-period moving average. Longer periods result in a smoother line that reacts more slowly. The choice depends on your trading style and goals. It also depends on the specific currency pair you are trading. Experimentation can help find what works best. Standard deviation is a key concept in Bollinger Bands. It is a statistical term. It measures how much a set of values varies from its average. In Forex trading, we use it to measure price volatility. Volatility tells us how much the price of a currency pair is moving. High volatility means big price swings. Low volatility means smaller price movements. Standard deviation helps us quantify this characteristic of the market in a precise manner. Standard deviation is used to calculate the upper and lower bands. These bands are drawn around the middle moving average. Typically, the upper band is set at 2 standard deviations above the middle band. The lower band is set at 2 standard deviations below the middle band. This creates a flexible channel that surrounds the price. The width of this channel changes. It widens when volatility increases. It narrows when volatility decreases. This dynamic nature is very important. Why do we use 2 standard deviations? This particular setting is chosen because it tends to contain most of the price action. Statistically, about 90 to 95% of all price movements usually occur within these 2 standard deviation bands. This is not an absolute rule, but it is a reliable guideline. It helps traders define what is a relatively high price or a relatively low price. Prices outside this range are less common. They may signal something significant is happening in the market. A very useful feature of Bollinger Bands is how they visually show volatility. When the market becomes more volatile, the bands will automatically widen. This indicates that price swings are getting larger. It suggests uncertainty or strong directional moves. Conversely, when the market becomes quiet and less volatile, the bands will narrow. This is often called a squeeze. It signals that price movements are small. This change in band width is a critical signal for traders looking for opportunities. The upper band of the Bollinger Bands represents a level that is relatively high. When the price of a currency pair touches or moves near the upper band, it might suggest an overbought condition. This means the price has risen quite a lot in a short period. It could be an indication that the upward momentum is slowing down. Perhaps the price is due for a pause or a pullback lower. However, it is important not to automatically sell just because the price hits the upper band. Context matters. The lower band, on the other hand, represents a level that is relatively low. When the price touches or moves near the lower band, it might suggest an oversold condition. This implies that the price has fallen significantly and quickly. It could be a sign that the downward momentum is weakening. The price might be ready for a bounce or a rally upwards. Again, this is not a signal to buy immediately. Traders should look for other confirming signs before acting on this information. Sometimes, in very strong trends, the price can walk the band. This means that in a strong uptrend, the price might repeatedly touch or move along the upper Bollinger Band. It can stay near the upper band for an extended period. Similarly, in a strong downtrend, the price might hug the lower Bollinger Band. This walking the band is a sign of a powerful and sustained trend. In such cases, the band is not acting as a reversal point. Instead, it confirms the trend's strength. Occasionally, prices can move outside the Bollinger Bands. A close above the upper band or below the lower band is less common. This usually signals a significant market event or very strong momentum. Such a move might be the beginning of a new strong trend. Alternatively, it could be a sharp, unsustainable move that will quickly reverse. This is often called a volatility breakout. Careful analysis and sometimes waiting for further confirmation are needed when price moves outside the bands. These are important moments to watch. Section 5. Spotting opportunities. Identifying trend reversals and continuations. Bollinger Bands are very helpful for identifying the direction of a trend. When the bands are generally sloping upwards, it suggests an uptrend is in place. In such a market, the price will often trade in the upper half of the channel. That is, between the middle band and the upper band. The price might also bounce off the middle band, using it as a dynamic support level. Observing this behavior helps confirm the uptrend and find potential buying opportunities. Conversely, when Bollinger Bands are sloping downwards, it indicates a downtrend. In a downtrending market, the price will typically be found in the lower half of the channel. This means it trades between the middle band and the lower band. The middle band may now act as dynamic resistance, preventing prices from rising further. The consistent slope and price position relative to the bands are key visual cues. These help traders confirm the downtrend and look for selling opportunities. Bollinger Bands can also help spot potential trend reversals. Classic chart patterns like W bottoms and M tops become clearer with the bands. A W bottom often forms near the lower band. Price makes a low, rallies a bit, then retests the low. This second low is often higher than the first, and within the lower band. A breakout above the middle band then confirms the reversal. An M-top is the opposite. It forms near the upper band and can signal a top. Beyond reversals, Bollinger Bands can also signal trend continuations. After a period where the price moves sideways, it might break out. If the price breaks decisively above the upper band, and the bands start to widen, it can signal that the previous uptrend is resuming. Similarly, a breakdown below the lower band with widening bands can confirm the continuation of a downtrend. The bands provide a clear visual for the strength of such breakouts. Always look for increased volume to support these moves. Section 6. The Bollinger Squeeze, anticipating big market moves. A Bollinger Squeeze is a very interesting and useful pattern. It happens when market volatility drops to very low levels. When this occurs, the upper and lower Bollinger Bands move closer together. They appear to squeeze the price action on the chart. This narrowing of the bands indicates a period of consolidation. The market is quiet, and prices are trading in a tight range. It often means the market is gathering energy for its next significant move. Many traders view a Bollinger Squeeze as the calm before the storm. These periods of low volatility are often followed by periods of high volatility. It is like a spring being compressed. When released, it can expand powerfully. The market is essentially building up pressure during a squeeze. Therefore, traders watch these formations very closely. They anticipate that a breakout from the squeeze will lead to a strong and often sustained price move. This is a primary signal for many trading systems. Identifying a squeeze is mostly a visual process. You look for the bands to become unusually narrow. Compare the current width of the bands to their width over recent history, perhaps the last 6 months or a year. When the bands are at their narrowest point for a considerable time, a squeeze is likely in effect. The bands will look very tight on your price chart. This visual cue is powerful because it is easy to spot. It clearly signals that a potential trading opportunity is developing. Trading the breakout from a Bollinger Squeeze is a common strategy. Once the squeeze is identified, traders wait for the price to break out. A sustained move above the upper band signals a potential upward breakout. This could be an entry point for a long position. Conversely, a sustained move below the lower band signals a potential downward breakout. This might be an entry for a short position. It is often wise to wait for a candle to close outside the band to confirm the breakout. This helps to reduce the chance of acting on a false signal. Section 7. Riding the wave. Profiting from breakouts. A breakout in the context of Bollinger Bands occurs when the price moves outside the established channel. Specifically, a bullish breakout happens when the price closes above the upper Bollinger Band. This suggests that buying pressure is strong. It could be the start of a new uptrend or the continuation of an existing one. A bearish breakout happens when the price closes below the lower Bollinger Band. This indicates strong selling pressure. It may signal the beginning of a new downtrend. It is important to confirm a breakout. Not every price movement that touches or slightly pokes outside the bands is a true breakout. False signals can occur. To confirm a breakout, traders often look for additional signs. For example, does the price candle actually close outside the band? A close is stronger than just an intraday poke. Is there an increase in trading volume accompanying the breakout? Higher volume adds conviction. Do the bands themselves start to widen as the price breaks out? This shows increasing volatility supporting the move. Once a breakout is confirmed, Bollinger Bands can help with trade management. For instance, they can assist in setting potential profit targets. Some traders project the width of the bands before the breakout. They use this distance as a possible target for the move. Stop-loss orders are also crucial. If you enter a long position on a breakout above the upper band, a stop-loss could be placed below the recent breakout level. Or, it could be placed below the middle band, which might then act as support. Traders must also be aware of the head fake or false breakout. This is when the price briefly moves outside a band. Then it quickly reverses and moves back inside the channel. These false moves can trap unsuspecting traders. They can lead to losses, if not managed carefully. One way to try to avoid these is to wait for a full candle to close outside the band. Some traders even wait for a second confirming candle. Combining band breakouts with other indicators can also improve reliability. Patience is often rewarded. Section 8. Smart Trading Risk Management with Bollinger Bands. No matter what trading tools you use, risk management is absolutely crucial. Trading Forex or any financial market always involves risk. Bollinger Bands are excellent for helping to identify potential trading opportunities. They provide valuable insights into market volatility and price levels. However, they do not, and cannot, guarantee profitable trades. The primary goal of risk management is to protect your trading capital. This is arguably the most important skill a trader needs to develop. Without it, even the best strategies will likely fail in the long run. Bollinger Bands can be very helpful in setting appropriate stop-loss orders. Stop-loss orders are designed to limit your potential loss on a trade. The bands themselves provide logical reference points. For example, if you decide to buy near the lower Bollinger Band, expecting a bounce, you could place your stop-loss order just below that lower band. If you are trading a breakout above the upper band, your stop-loss might be placed below the breakout point, or perhaps near the middle band if it trails the price upwards. This helps define your risk clearly. The width of the Bollinger Bands reflects market volatility. This information can be used for position sizing. When the bands are very wide, it means volatility is high. Price swings are likely to be larger. In such conditions, it might be prudent to trade with smaller position sizes. This helps to keep your risk per trade consistent in dollar terms. Conversely, when the bands are narrow, during a squeeze, volatility is low. Knowing the current volatility environment thanks to the bands allows for more informed decisions on how much to risk. It is also important to avoid over-relying on any single indicator, including Bollinger Bands. They are a powerful tool, but they are not a standalone trading system. They work best when used in conjunction with other forms of technical analysis or indicators. For example, you might combine them with trend lines, support and resistance levels, or volume analysis. Understand the limitations of Bollinger Bands. Always have a comprehensive trading plan. Most importantly, always adhere strictly to your predetermined risk management rules. Discipline is key. Section 9, Conclusion: Mastering Forex with Bollinger Bands. Throughout this essay, we have explored the nature and application of Bollinger Bands. We have seen that they are constructed using a central moving average. Two outer bands are then created using standard deviation. This design allows them to adapt dynamically to changes in market volatility. This adaptability is what makes them such a versatile and widely used tool for traders. They offer a clear visual representation of price action relative to its recent behavior. This clarity helps in making trading decisions. We have discussed several key strategies that utilize Bollinger Bands. These include identifying breakouts from periods of consolidation. We also looked at the Bollinger Squeeze, which signals potential for strong moves. Furthermore, we saw how bands help in identifying the direction of trends and potential reversal points. These strategies provide frameworks for finding entry and exit points in the market. Remember that confirming signals with other evidence often leads to better results. Understanding the broader market context is always beneficial. Understanding the concepts behind Bollinger Bands is the first important step. However, to truly master their use, practice is essential. I encourage you to use a demo trading account. This allows you to test these strategies without risking real money. Observe how the bands behave in different market conditions. See how they interact with price action on various currency pairs. Continue your learning journey in technical analysis. There is always more to discover about the markets. Knowledge and experience build confidence. In conclusion, Bollinger Bands can be an invaluable addition to your Forex trading toolkit. They provide unique insights into price behavior and market volatility. When used thoughtfully and with discipline, they can significantly enhance your trading analysis. Always combine their signals with robust risk management practices. This is the foundation of sustainable trading. I developed these bands to help traders better understand markets, and I hope they serve you well. I wish you the very best of success in your trading endeavors.